Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, October 17th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, is the U.S. consumer still resilient? And will the ECB spoil the weak dollar party? Our answers are the September retail sales data are supportive of our 2-plus-year-old resilient U.S. economy theme. Today, the ECB cut its benchmark policy rates by 25 basis points apiece. The euro can stabilize here and even strengthen if we are right on our grid model projections for both Eurozone and global growth to accelerate over the medium term. Among the world's 10 largest central banks, the Bank of Canada, the ECB, the Bank of England, and the Fed are cutting rates with core CPI comfortably above target and into easing base effects over the next 12 months. The PBOC and Swiss National Bank are also cutting rates. As we discussed in our October 12th Around the Horn, we are all frogs being boiled alive in a pot of monetary debasement and financial repression water to prevent global sovereign debt markets from accurately pricing in upside risk into both supply and inflation over the long term amid increasing forth-turning barriers to economic and geopolitical cooperation. So let me repeat that again. It's one of the most important things I've ever said in my 15-plus year career on Global Wall Street. As we discussed in our October 12th Around the Horn, we are all frogs being boiled alive in a pot of monetary debasement and financial repression water to prevent global sovereign debt markets from accurately pricing in upside risks to both supply and inflation over the long term amid increasing forth-turning barriers to economic and geopolitical cooperation. This is very consistent with our forth-turning research, which we debuted last August. This is very consistent with our Jay wants a soft landing theme, which we debuted at the beginning of November of last year. And obviously, we've seen the requisite performance in asset markets with things like stocks and credit, crypto, gold, all those things being straight up and to the right. Obviously, you've had a little bit of a blip in the treasury market, but generally speaking, treasuries have severely lagged the performance of all these other assets, which are, sort of the release valve, the escape valve, if you will, from all the financial repression and monetary debasement that we continue to observe, not just here in the U.S., but around the world globally. With respect to, go back to the Bank of England pivoting as a function of the UK gilt crisis. Obviously, that dragged ECB rates down with it. The Federal Reserve pivoting as a function of the regional bank crisis last spring, causing a significant shift in the forward rate curve here in the U.S. And all those things have contributed to what has been a relatively steady increase in global liquidity and U.S. liquidity as well. Don't recall that the RRP balance started falling like a stone once post the regional bank crisis, once the forward rate curve in the U.S. shifted from pricing in more rates hikes to pricing in rate cuts on a perpetual basis, because markets now know the Fed has an asymmetrically dovish reaction function, which is something, again, we've been pounding the table on since November 2nd of last year. So let me get back into this executive summary here. That dynamic, which is the monetary debasement and financial repression, is structurally bullish for risk assets. Again, we've been arguing this for almost a year now. There will be periods of cross-asset volatility associated with policymakers being forced to tighten for credibility's sake. KISS, our systematic KISS portfolio construction process, and Dr. Mo, our systematic discretionary risk management overlay for institutional investors to stay on the right side of factor long-short risk. Those tools will be there as long as I'm alive to help you guys risk manage those potentially steep drawdowns. And, whenever policymakers are forced to tighten for credibility's sake, and they will be there to help you get back invested once those lows are confirmed. Transitioning to our 42 macro dashboard here is always a wrap up with a question from our community. This is not a question, just a comment or someone sharing the Druckenmiller interview, which in my opinion is required watching for you today. If you are an investor operating in global capital markets, if you're listening to me today, if you think I'm important enough to listen to, you definitely need to take 20 minutes out of your day in the next 24 hours to watch this Stan Druckenmiller interview. I will tweet it out. Stan Druckenmiller is obviously one of the best investors of all time. I would argue he's arguably the best discretionary trader of all time. And Stan Druckenmiller shares many of the same core beliefs that we share, and we have, arrived at, based on our data-driven, views here at 42 Macro. We share many of the same beliefs, which is that the Fed has an asymmetrically dovish reaction function. Investors should prepare for sticky inflation over the medium and long term, and ultimately the political will to do something about the U.S.'s burgeoning debt and deficits is not here. And as a function of that, we're going to continue to see populism, and that incremental populism may cause problems in asset markets whenever there's too much supply and not enough monetary debasement and financial repression. So there will be pockets, air pockets, where, I call them global refinancing debt air pockets, whenever you have the private sector, the public sector crowding out the private sector, much like what we saw in 2022. I would argue we saw similar dynamics in 2018 as well. That's going to continue to accelerate. We also saw it in COVID as well. Remember when the treasury bond yields spiked on a real basis very high, kind of towards the lows of that market sell-off. Again, these are moments in time where we're getting a preview of what the next decade is probably going to look like. Markets go straight up and to the right. We have an issue. If a global refinancing air pocket, markets are straight up and to the right. We have a global refinancing air pocket, and that's the rinse and repeat. So this is why, but one of the reasons why we built our KISS and the systematic KISS portfolio construction process and our discretionary risk management overlay is to take advantage of the sustained bull uptrends that we're likely to see over the long term as a function of the financial repression, monetary debasement, to stave off these refinancing air pockets, but they will happen. And so ultimately, you need to have a risk management system that is not only good at keeping you invested when the markets are in a raging bull market like the ones we've been calling for for really the better part of almost 2 years now. Recall that we pivoted bullish in January of 2023. Our risk management systems went bearish in March and April of 2023. They got back bullish in May, so we were bullish in May. Our risk management systems got bearish in September of 2023. So we were bearish in September and October of 2023, and then they got back bullish in November of 2023 and have been generally bullish ever since. So again, everything I say out of my mouth about monetary debasement, financial repression, refinancing air pockets, growth, inflation, policy, all these other things, they don't dictate what our clients experience in their portfolios here at 42 Macro. The only thing that dictates what our clients experience in their portfolios or what our systematic trend following systems are designed to do, which is keep them on the right side of market risk, whether they're maximizing upside capture in bull markets or minimizing downside capture in bear markets. And if you're doing anything else other than that, then God bless you, because we're not going to help you with it. So we'll wrap it up there. Darius Dell presenting our macro minute for Thursday, October 17th, 2024. Check me out. I'll be on our friend Charles Payne's show on Fox Business sometime in the 2 p.m. hour. So I'll tweet that out. My hit time when I get that information. So everyone have a wonderful day. We'll catch you back here tomorrow. Cheers.